Cool. Thanks for that, Daniel. Um, Actually, questions such as, I'm about to start fundraising, how much equity do I sell? That's a great question to ask during this workshop. So I didn't want to butt in there immediately when Daria was asking her question, but yeah, should I answer the question? Should I do you want me to answer it right now? Talk a little bit about that, or
I think
if it's possible, then sure. I would love to hear what you're thinking.
Yeah. All right.
Sure.
Okay. So first rule of fundraising is, by the way, if you have any questions that you really want me to answer during this, 45 to 60-minute keynote about, fundraising, then tell me them in a second. I'm quickly going to answer Daria questions first, and then I have a couple of slides, but I'm very open to answering your questions. So first rule of fundraising is don't. Right? Don't do it unless it's absolutely necessary. What do I mean by that? If you sell your share, you're never going to get it back. So you have a limited amount of shares before you kind of just run out of, percentage of stock that you own. However, your product you can sell hopefully an infinite amount of times. So I always caution startups when I talk to them, hey, maybe it's an idea, instead of, going to angel investors or going to investors to sell your shares and get money, maybe considering pre-sales or just selling a crappy version or whatever. So I think that is the first thing you want to consider. No, okay, we've considered that. It's impossible. We need to fundraise. Then I would say try to be as, stingy as you can, even more stingy than the Dutch are on your shares when you're selling them. Because if you sell too many shares right now, you're going to run into trouble later down the line, because you will probably be doing a couple of rounds, maybe 2 or 3 seed rounds before you hit your Series A, right? Maybe 4, maybe 1, maybe 2, really depends on the type of startup. But it's always, you can make a strategy, but you're always going to do one more funding round than you're counting on. And now the idea here is that, and this is what VCs like as well, that after you've done your Series A, you as a founding team own more than 50% of the shares, of the remaining shares, fully diluted, if that says something to anybody. But which means that going in, I would say you have, you want to own about 70 to 75%, excluding any convertibles and stuff like that. So Daria, if you're going to do one funding round, you can do 20, 25, 30%. You can go wild, right? But I would do maybe, steps of 5 to 10 or 15. Now, in funding strategy world, there are a couple of differing opinions, and I'm saying opinions because up till now, it's relatively hard data, where some might say, hey, why don't you raise money for 18 months? Because then you're done with it. I would say prior to your Series A, don't do that, because in your Series A, prior to your Series A, sorry, your valuation will go up very rapidly, very drastically, as you hit certain milestones. And if you then, raise money at your MVP level, MVP valuation for 18 months, then you're kind of, still, you're still using that share price 18 months later or 12 months later, when actually it's already gone up. So I would say personally, why don't you try to raise enough money to reach a significant milestone, and then you raise money, you succeed, and then you start, spending it to reach the next significant milestone, and in the meantime, prep your next funding round. That's more work that way, maybe the first or second time around, but overall, you end up with more shares. That's a real quick answer to your question. Real broad, what is your company worth? There's this thing called the valuation conundrum. Nobody knows. Nobody knows what your company is worth in the first 5 years, probably. And if you have a beautiful Excel for me, well, that says that this is what it's worth, well, or a report, it's, no, it's no hard scientific method. So it's a subjective truth that you come up with together with the people putting the money in, or the person putting in the money. As a general rule of thumb, regardless of your industry, so this is very, very, very specific, right? Non-specific, apologies. I would say that you can start thinking of a valuation / cap of $500,000 if you're at an MVP level. And if you have non-zero revenue, so it doesn't have to be a lot, it can be just one customer, two customers, something manual if you're a SaaS, then you can start thinking of 1 to 1.2 million. So there you see how drastically it doubles overnight. If you can tell me, hey, I have revenue, I have 2 customers, then your valuation goes from MVP to first revenue, it doubles overnight. And it's a shame if you would have funded at an MVP level for 18 months. Does that help you a little bit, Daria?
Yeah, it's really great. And actually, also I've been reading about it and of course watching a lot of YouTube videos, but this is really kind of recaps what I've also learned till now. And yeah,
Awesome.
It's actually very insightful. And about the valuation, it's also something that I've been looking for, like how to determine that, because it's indeed very subjective. But it's good to know, yeah, about MVP and about like having first traction. And
all right, good to hear. So when you're reading, so to everybody, right, when you're reading material on this, be very aware that the investment culture in Europe is very different to that in the UK and the US, as in that the valuations that you might get in the US might be 10 times higher, but the amount of competitors that you get in the US is also 10 times higher, and they'll actively steal your tech and whatever. If you're looking for literature to kind of help you on this, I would say try to read get information that is particular to the place where you incorporated, and maybe to just, I don't like plugging what we do because this is about you learning and not me about talking about our company, but we have quite a bit of information here on leapfunder.com/academy where you'll find a lot of the stuff that we've that's particular to the European ecosystem. So all right, cool. Are there any other questions that you really want to have answered with regards to fundraising?
I've got a question, and it's
yeah, go ahead, John.
I'm wondering whether you're just going to be describing everything dealing with stocks or equity, like Ms. Daria was talking about, in exchanging stocks for funds. I've got no stocks. I've really got no money. I have a great idea worth millions, billions probably, and it's just a matter of getting a foothold in some place to start up the project and put all these. See, I'm a clean energy developer, and I have proprietary systems to develop. And it's just that because of the market of being, well, I'm in the US, and worse, I'm in Hawaii, and the thing about our power cartel doesn't allow for really innovations and or application of green tech. And so I'm looking to go to the mainland, which, or if you can take me all the way to UK or EU, is to bring Hawaii to there by creating a Hawaiian marketplace or a Hawaiian park, and have a marketplace all year round. And in that,
what's your question here, John?
I'm going to look to try and find ways of raising funds, and it's going to be like a fundraiser luau or pre-selling lease space in this facility. I have, like I said, I have no other way. And when you first go off on saying, "Oh, don't do any fundraising," I'm thinking, well, I came to the wrong place. But
unless you, I said the first rule of fundraising is consider selling your product, right? If you can't, then you obviously have other options. So there are a couple of other things right. Okay, thanks for your question, John. So there are a couple of other things you could do. So try to sell your product is number one in this game. Second is you could consider a loan. Now the thing is, as a startup, you don't have a lot of collateral or assets, which is things that banks ask for, right? So what do the Dutch banks? So some Dutch banks, they will give you just a loan, pretty good loan, 30, 40K, and they'll just write it off as PR. I think that's what that Rabobank is basically doing. That instead of sponsoring hockey fields, they're just kind of sponsoring startups, which is good. It's free money, so you can use it. if it becomes more larger loans, what I tend to see is that banks want you to sign for it on a personal level, right? So it's a personal liability, which means that if the BV goes bankrupt, then the loan, instead of like staying in the BV, which normally happens with a bankruptcy, it sticks to you personally, which means that you then, as a person, have to pay it off. This is something I would advocate against almost always. It's the equivalent of trying to, you being in a little rowboat and trying to, I don't know, tug a mammoth tanker. That mammoth tanker is the corporate loan, right? The bank loan, and you and your little tugboat is your annual income, basically. It's not a fair comparison. So pros of a loan is you're not selling shares, which, yay, that's the aim of the game. Keep as many shares of a successful company as you can. And the unfortunate downside is sometimes it sticks to you personally. And the other thing is it might scare investors, because if you have a debt with a bank for 100,000 euros, and you're trying to raise 100,000 euros, right? Then what's going to happen with that money? It's just going to probably go immediately to the bank and not to the improvement of the company. Now, third thing you can do, and maybe that's something for you to look at, John, is subsidies. Now, Europe has a couple of interesting subsidies. There's also, maybe for your case, there's subsidies for early stage startups. There's also subsidies for foreign startups trying to come to the Netherlands. And in this case, what you're looking for is a ROM, is a regional development agency. Let me type it in chat real quick. So that might be something to look at. However, subsidies are subsidies are free money, right? Basically. So again, it's not selling for shares, which is good. Every province in the Netherlands has a ROM, by the way. So there's a ROM Utrecht and ROM South Holland, which is Innovation Quarter, which is where CAC is also. So upside is you're not selling your shares again, but the downside of a subsidy, it's a bit of a black box, hit or miss. So often it takes a lot of time, and then you say, okay, here are the papers, and then you'll hear if you get the money or not. And in the meantime, you need to develop a plan B. What if you don't get the money? And if you do get the money, what strings are there attached? Because it's public money, and there will always be strings attached. So choose your poisons. And then in general, I'll get to it in a sec because I have some slides, right? If you're tired of looking at my face, but in general, if you then turn to investors, so people who invest their own money in cool little scrappy startups, such as the ones here, they look at it from a point of view of, okay, I'm putting my money, it's a high risk investment. 60-70% of startups don't make it. So if I put my money on all of them, then I'm already down 60 or 70%, which is not good if it's your own money. I mean, the previous speaker undoubtedly talked about being cautious and how do you want to multiply your money. Well, you don't want to start multiplying your money by going down 70%. So what they do is they try to look at startups that show tangible results. In Europe, we're very revenue and traction oriented. In the US, it's far more growth oriented, far more high risk, high reward appetite. But the more real you can make it, the further you can get away from that beautiful business plan, on paper, that beautiful spreadsheet in Excel, that beautiful pitch deck in Word or in PowerPoint, the further you can take it from there to actual paying customers, even if they're just paying customers for some duct tape version. The further you can take it from there, the more you can take it into reality, the more real it becomes, the easier it is to find investors. Because at the end of the day, investors are also, like you are probably looking, all of you will at some point in time will probably be looking for investors. But investors are also looking for you because they want to invest in their money in startups that are going to be part of that 30 to 40% that makes it, that are going to give them 10x their money back, 15x if it's really well. So it's a mutual thing, right? So don't go chasing an investor at the door. That's not okay. But also don't be chased. But if you can communicate, if you are a good startup and you can communicate that, then also investors will find you. I've taken your prompt, John, and run with it and broadened it a bit, right? So I'm not entirely sure if I totally answered your question, but it was an interesting point to start from. So cool. Any other questions you really would like me to talk about?
Yeah, I have a question.
Thanks, Bart. Yeah, go ahead.
How do you just determine or just come up with the number of shares that you want? Is it just a random number that you bring up with, or like that you like think of, or is it like also a calculated process?
Yeah, that's a good question. So at the end of the day, so thanks, Lester, for that. And by the way, thanks, Bart, for sharing more info on the rooms. You might probably are part of a room, I guess, then if you have that handy. But so Lester, yeah. So in the Netherlands, if you want to, you can create an infinite amount of shares, basically, right? But you need to go to a notary, and they will issue extra shares. Now, so the amount of shares that you own, can be really cool. It can be 10, it can be 100,000, it can be 1 million. It doesn't really matter. But what you look at is the total value of the issued shares. Now, please keep in mind, when I talk about shares, I don't talk about shares on the public market. That's a different thing. We're way before that. We're 8 years before that. We are at that stage where you go to the notary with your co-founder, and at that point you just say, well, why don't you take 10 shares? I'll take 10 shares, and 20 shares. That's 100%. So 10 divided by 20 is 50%. Cool. And then you come to this point where you say, hey, listen, what is it? What's the value of the company, right? Maybe the company at that point in time is worth 200,000 euros. You had 20 shares, and then wow, each share is 10,000 euros. Oof. So if we need 10,000 euros, we can sell off a share, or what you technically do is you issue a new share, you sell them a new share, and then you have 21 shares. Then the total value goes down a little bit. So to answer your question, in the beginning, I would totally be relaxed about the number of shares that you own, because if you own, because it's really unwieldy, right, to have 10 shares. So if you then go to the notary and say, hey man, can you put extra zeros? I want 10,000 shares. Fine, he'll do it. He'll send you a bill, and it's fine, right? But the problem, what will happen is the overall value of the company will remain the same, but just the share price will go down, which makes it a little bit easier to trade. So to answer your question, I wouldn't really bother about it in the beginning. Once you start doing funding rounds, that will kind of figure itself out. But it's an interesting question. Hope that helped a little bit.
Yes, and you also said once you have paying customers, your value will go up by a half at least. Let's say
well, it'll double, but it'll be great. Because if you tell me no, this is so, would you rather put your money in this startup and in this company that's saying, well, with your money, we will probably be able to make money, versus, well, we've got 2 people giving us 10 euros, and with your money, we can make 20 people out of that.
Yeah.
Giving 100 euros.
Okay. Yeah, true.
If it's your own money, then you go well, I mean, I like the first guys, but I like the second one as well. So, right. Cool. Awesome. Any other questions? Or shall I blitz through my screens then? Cool. Let me start sharing my screen a little bit, because I do have some slides, obviously. Let's do the full screen. So, by the way, I'm not seeing the chat right now. So if there is a question, then maybe one of the co-hosts, Daniel, or just speak up. Let's do that, right? If you have a question, then speak up, please, because I can't. You're literally seeing what I'm saying. This is my screen. And maybe another thing, if I start talking, startup lingo, I don't know, angels, fully diluted, that kind of jazz, and you don't know what it is, speak up and interrupt, because this is your remaining 35 minutes, to really get a clear picture on what is fundraising. So make the most of it. Cool. This is me. I work for a company called Leapfunder, and I'm responsible for our Dutch operations. And this is me pre-COVID, so hopefully I still look the same. Just real quick, what we do, think of us as a marketplace where the only thing you have to do is kind of feed investors into that process, and then we'll take care of all the rest. Funnily enough, startups tend to think that meeting investors is the only tough thing they'll face. It's the first thing you'll face, but I don't think it'll be the toughest. It's actually the stuff that happens after that. You can do your own contracting, right? And it might go well. The same way that if you do your own electrical wiring, it might go well. Or your apartment might just burn down 2 years later because you missed a detail, which can, if you do your own contracting, same might happen. So we kind of take care of that. Just make sure that you can focus on fundraising and not on the boring details, right? So we're operational in Benelux and DACH, and we actively coach startups on how to talk to investors and how to fundraise. We actually also do a little bit of that on the investor side. We have about 1,500 angels in our network. We have meetups twice per month, and yeah, that's it. Gonna skip past this real fast. So how could you look at fundraising from a startup point of view? Well, I don't know if you have gone on road trips before, but I have in the past, and I can always recommend it. Now, the game here is what you do is you get into a car and you have a full tank of gas, right? Which gives you a certain span of kilometers, and then you have a set amount of money. So once the gas tank is getting empty, you have to tank up, right, to increase that length of kilometers that you can drive. And now there's this funny thing that you get more gas for the same amount of money depending on where you tank up, right? I mean, the further east you go, Netherlands, Germany, Poland, the more gas you get for the same amount of euros. And so there's this real thought process of, okay, I can choose to, I'm halfway through my tank. I can choose to tank up here in the Netherlands, or I can try and, reach the Czech border, because then, I'll tank up fully. I might also strand halfway, right? Almost there, but you can tank up fully for quite a cheap price. Now with fundraising, that's exactly the same mechanism. You have a runway, right? The amount of months that you can fund your startup. You have a set amount of shares that you can sell. You can always issue more, but the value of the shares goes down, right? So you have a set amount that you can sell off. And then the funny thing happens is the more mature your company is, the further along you are, the more your shares are worth. And so if I would sell 10 shares at an MVP level versus 10 shares at a first revenue level or post revenue level, I might get right twice as much money. So I get twice as much runway, runway for the same amount of shares. So if you are, in the driver's seat of your startup, you're always kind of keeping one eye on the gas tank, right? So how much runway do I have left? And you're keeping one eye kind of on the significant milestones, aka the gas stations that are coming up, because you don't want to run out of runway just before a significant milestone, because in that case you should have fundraised earlier. But if you can make it, then raising after a significant milestone is preferably, because it does good things for the valuation of your company, which means that you end up with more shares. So that's how you should see fundraising. Now, this is how investors might look at their funding strategy, right? So good investors, and with us, our like 30 best investors, they make about 26% return per year. So I don't know if Plony's still in the chat, but 26% per year compounding is not a bad return. Of course, this is the 10% highest risk of the portfolio, but still. So what we see them do is they are building a portfolio of startups. And for them, it's just a day at the races, right? So they put money on all the horses, and then they watch them run a lap. And then they, when they come by again, they just look at, okay, who's up front and who's lagging. And the ones that are lagging are the ones that are probably going to go 0x, right? They're part of that 60, 70% that will probably not make it. So you stop funding them, you just eliminate them and, put in new horses. But the ones at the top, the ones that are doing really well, they're up for a new funding round. those are the ones you want to reinvest in, because a startup that's looking to go 20x, you want as much money in there as you can possibly get, while still spreading your risk. So for investors, there's a couple of things that's worthwhile. First is, don't put all your money in 2 or 3 horses. Just spread it around, but keep at least 40% in reserve for follow-up investments on the ones that are doing well. And the other thing is, if you are you might be, as a startup, part of this group of horses, right? And so it's not only the fact that are you performing well, but also in relation to all the other startups in his or her portfolio, are you then still doing well? So that's something to keep in mind. And this is how we see sometimes, strategies differ, obviously, but this is how we see some investors do good things. Any questions so far? Cool. And then this is what I was talking about, right? In the beginning, your company will go up in valuation quite drastically. So at an ideal level, it might be 200, 300,000 euros. At an MVP level, 400 to 600. And then, first revenue is 1 to 1.2 million onwards. And then afterwards, it's very tough. It differs really per industry. If you are in doubt what the precise valuation of your company is, you might talk to friendly angels that might not be interested in investing in your company, because then you'll get a more straight answer. I usually recommend talk to startups that are in a similar field as you, that do what you do roughly, but are 3 or 4 years older, because at that point you're probably not a competitor, and they're in a totally different headspace altogether, in the scale-up phase, totally different, but they will probably be able to share some of their insights. So I would always recommend trying to talk to these kind of startups, find some mentors there in those founders, to get a grasp of, okay, what are good terms, and what are the fuck ups that you want to prevent. Now, roughly speaking, there are a couple of people you could turn to for money. Like in the beginning, you might, when you don't have a lot of tangibility, you might go for friends and family. And these are the people who kind of have are a little bit more in love with the idea than than they maybe should, right? Or because they like you, or they believe in you. Because there's not a lot there, so they're taking kind of a leap of faith. And friends, family is usually 20, 30, 40, maybe max 50K, I would say, approximately. After that, it becomes a bit expensive. I read somewhere that there was a startup that did a friends family round of 2 million. I think that's a huge outlier. For me, the reason I say 20, 30, 40, 50K max is, again, if your valuation is only 200, 300,000 euros, if you raise 100,000, that's 50%. That's a killer. Then you have 0 leverage left in the future for future rounds. So friends, family. Then I would say from 50K up to 500,000 / 1 million, that's when you get into angel territory. These are people that invest their own money, and they're individuals, so you can find them or you can talk to them, and they make up their own mind. So sometimes they are, they might seem rational, but they might sometimes make a little bit of a gut feeling call. And they'll get in at an MVP level, and they'll also get in later. And then you have people called VCs, and these venture capitalists, and these are people that invest other people's money, and they usually do 3 to 5 million tickets, rounds in total. You have early stage VCs, sure, right? I just see them as kind of like an angel syndicate, because they do the smaller tickets. And in between, right? So 500,000 to 1 million versus 3 million, there's this kind of valley of death, is what it's called, where you are performing well, but it's really tough to find angel investors because you're too expensive for them. The round is too expensive for them, and you're not performing well enough for VCs. So you need to keep on burning. I would say VC territory is 30,000 euros monthly recurring revenue. That's when you start to be a serious contender for VC territory. Now, VCs tend to come with preferred rights, which I think, okay, whatever. Might make sense if they're investing 3 million. I would try to postpone the preferred rights before the Series A. So if you're talking, for instance, to an early stage VC who does 100K and they come with preferred rights, you might want to try to negotiate that they only do common shares, common rights. Cool. Yeah, so how to get funding as a startup. Sorry, no nice picture, just a very long list of text, right? But what you want in essence is to have, it's a numbers game. You want to have options, right? So over the course of building your company, so fundraising is not a, oh my God, we're starting to fundraise and now I'm only going to talk to investors. It's as a founder or as CEO or as whatever, you want to always have your eyes and ears open for a potential investor. And these are people that like what the company's doing. They like you as a team. They have some money, 5,000, 10,000, 50,000, 100,000 lying around, and they might someday invest in your company. You just don't know when. Spoiler alert, they also don't exactly know when. So you build as long a list as you can of these people, and you interact with them regularly. And every time you talk to them, you want to drop, a little growth story that goes from good to better to best, right? Now, if these people come up to you waving money in your face, like, hey, I want to get on board, then you don't want to drop it. Like, the reaction is not to drop everything and talk to these people. The reaction is to, remember, we're driving in the car. We're looking at our gas tank, and we're looking, when is the next gas station coming up? So you look at your business plan, you look at your runway, and you say, oh, that's really cool. According to our business plan, we're due to fundraise in 2 months because that's just after our expansion to Germany. Spoiler, if you are a Dutch company and you go to Germany, what do you think your valuation is going to do? It's going to go up, right? So it's okay to park these people and just feed them, growth updates. Keep them enthusiastic, but you don't have to engage with every investor. Because, like I said, good companies will have investors coming up to them, and then it's a game of, okay, in that scaling of operations, in that route to the expansion, you do the fundraising on the side, and then once you've hit your German operations, you immediately do the fundraising at that valuation. Like I said earlier, raise enough to reach a significant milestone, right? So that you can always come back and say to that group of investors, hey, this is what I've achieved. Can I get some more money to achieve even more? And the longer that list is, the more options you have. Never say a hard no to an investor, right? Like, oh no, I'm not fundraising right now. Rather say, I already said it, right? You never want to say, no, I'm not fundraising. You want to say, at the moment, we're not fundraising. Can I keep you in the loop? So you always keep them hooked. And the same is what an investor will do. A good investor will not say, I'm not going to invest in your company. He or she is going to say, right now, I don't think it's the best fit for me. So if you are, trying to fundraise and people say, right, I'm out, then don't be disappointed. Don't be harsh at them. Just keep them in the loop, because they might change their mind for this round. They might change their round for the second round. They might change their mind for the third round. They might, never change their mind, but you don't know, and certainly they don't. So keep that list long and keep your options open. And then if you do decide to get in bed together, have a contract that's ready for a worst case scenario, because things will go wrong, and so you want something that's resistant to that. So get a good contract.
I got a question for you, Mr. Huizing.
Yeah.
With regards to your site, I have another computer. Do you charge a fee for your list and or your help to get funding through your services?
So signing up with us is a commitment fee of 500 euros, just to kind of gauge how serious you are. And then you get our full support, and you get listed on the website, and et cetera, et cetera. And we take a no cure, no pay commission percentage of the funding round. However, you'd have to be incorporated. You'd have to be incorporated in the European Union in order to be eligible, unfortunately.
I couldn't piggyback
in
on
Europe,
somebody
have you considered, if you're American, have you considered Angel.co? We're basically the European Angel.co, right? So how much exactly? I can share it. It's it's sorry, I'm trying to keep an eye on the chat. It's €1,000 flat fee plus 5.5% of the first 150,000 euros. Anything over that is 3%. And then any large investments of 100,000 euros, we just charge a flat fee of 1,000 again, and not a percentage. Basically, what we do with the contracting and stuff, and to do it yourself, it'll cost you 8,000 to 9,000 euros, and we're most of the time cheaper. Daniel
so that's an investment in me, or I have to invest in your company, in the whatever. I mean, it looks
no,
like
the investor invests directly in the startup.
For the investor that you have, or the list, just to get the services of your list.
No, we're a marketplace. We're not the listing. So the startups is the list, right? So we're a marketplace.
Right.
And we have in our network 1,500 angels, but anybody can invest through Leapfunder.
Oh, okay, all right.
Crowdfunding, yeah. Sorry, Mark. Let me see. Crowdfunding. Yeah, crowdfunding is an interesting one. So I would say, yeah, I tend to forget it because it's not been that relevant in the Netherlands anymore for startups. So I see a lot of SME, MKB, right, being funded by crowdfunding. I would say if you are B2C and have like a cool physical product, I would definitely do a crowdfunder. For me, that falls under the category of a pre-sales, right? So that's how I just kind of lump it together, because a lot of crowdfunding is, well, if you give me the cash right now, then you'll get the product in 4, 5, 6 months time. Yeah, crowdfunding, do it. If it's a pre-sales, I would always recommend it. If it's a loan, don't forget, right? If you have like a 100, 200, 300K loan, then if you start repaying it, even if it's like the interest alone might kill your company, maybe, right? Because if the interest is not like, if the repayment of the interest is like 4K a month, then every month you need to have 4,000 euros of revenue. And in the beginning of a startup's life, the revenue is a bit, 1 month is okay, but the next month there's no revenue. It's a bit awkward sometimes. But do it. I usually do recommend the crowdfunder for equity though, and then One Planet Crowd, OPC, is actually a nice partner that we refer to. The main difference between doing an angel round and a crowdfunding round is a crowdfunding round, you are trying to reach a large mass of people through marketing where hopefully a large percentage of them will do a small amount. And in that case, your company information, the business plan, etc., needs to be publicly available. If you do an angel funding round, then it's a smaller group of people that you can all target, right, individually, and talk to them individually. And the round information, the business plan, is available upon request. So it's they're different tastes. If I had to choose, if you could do like a pre-sales, I would always do the pre-sales over a crowd loan or a crowd equity. Opinion idea phase is okay. Yeah, it could be. You can certainly try, but there's yeah, you could try. How is it to get funded MVP? Whoa. Sorry, how is it to get funded MVP without any customers, just one pilot? Well, you want to. So if you don't, you want to show growth somewhere, right? So maybe it's a waiting list that you're having a waiting list that's growing while you're building the MVP, and maybe you just try to sell the MVP with duct tape on it. And what's the usual time period for startups to achieve from 0 to achieve value of death? No, value of death is usually 4 years, I would say. So you'll have gone through plenty of stuff before you reach the value of death. In a traditional startup, medtech startup has it a bit earlier actually, but that's just why can't you continue without funding right now? Oh, that's a question to Daniel. Is a one-time fee? No, it's a one-time fee per round, by the way. But I do also do free consults, one-on-one sessions, by the way, which are, like I said, free. I'll drop my email in a second. shares could be sold during the angel round. What percentage would you recommend? Vikesh. Yeah, so Vikesh, this is something that I think Daria kind of asked as well. So the amount I don't care about, because the amount is, you could have 1 million shares that are worth, in total 10 euros. The amount is very unsubstantial to me. It's about what's the total value of the shares, and what percentage of that are you willing to sell? My answer to that is as little as possible. That's the first goal. And if you do decide, you want to calculate how many funding rounds you're going to do or plan, and then add one extra, because there's always one extra. And then, 5, 10, 15%. If it starts getting in the 20% range, then, doing 2 funding rounds will get you to 60%. And then after the Series A, you're probably down to 40. Let's say 45. If it's then 3 co-founders, you all each have 15%, 1.5, which comes awfully a lot in the territory of then just being, an employee in your own startup, that, blood, sweat, and tears, and you end up with a percentage that, somebody who joined 2 years later also might have. And then it's kind of, is it worth it then? So it's, so the lower you get, the more it is like a trade of like, maybe I just sell out, because I see all my friends driving in Teslas. Why not me, right? And so investors, a good investor knows this. A bad investor will say, hey, I want 30% of your company. But a good investor will say, well, why don't I do less? Because then you stick around longer. You have more, commitment to it. And how much that percentage is kind of depends, because the valuation depends on what you decide with your investor or investors. Obviously, as a rough guideline, again, I always tell startups, prove me wrong in the positive sense, right? If I say an MVP, that's 500 to 600K as a valuation, prove me wrong. I've had startups prove me wrong, and I go, good on you, right? But it's a hell of a journey to do that. And then post revenue, 1 to 1.2 million. Cool, awesome. I'll quickly get back to the slides, unless there are any questions right now.
Yeah, can I ask a quick question? Somewhere between your story, you said when you make like 30K revenue a month, that's in a VC level type of range.
Yes.
If you make 30,000 euros a month.
A month. Yes. Well, just 30,000 euros a month every month, right? So that's 360,000 euros per year.
Yeah. Okay.
Then you've got a good company.
I'm sorry?
Then you have a good company. If you go, oh, I'm already having 50K a month, then wow, what are you doing listening to me for? No, so it's kind of, how do you get up there, right?
Yeah. No, but yeah, it was a question because, it was a question.
Mm-hmm. No worries. Mark asked, do we charge the investors anything? No. The investors get their money's worth. So see of us as kind of, right? You could do your own electric wiring, but you can also hire the electrician. We're basically the electrician, right? When it comes to the funding round, because the joy of it is, you meet an investor. Let me do it this way. Sorry, the camera's just off. Oh, yes, you meet an investor. They want to invest. Oh crap, what now, right? You need to have a contract, because if you're talking to 5 investors and you don't have a contract ready, you're going to get 5 contracts, and then you have to smush it together. That's hell. So you send them your contract and make sure it's legal. So no, right? I saw a contract between a Dutch entity and a Czech entity, and I kid you not, it said this contract falls under UK and Welsh law. So that was just, so read your contract. And then, you send them your contract. You get 5, answers from lawyers back. You parry that. You discuss term sheets. They sign the term sheets. You negotiate the contract in the meantime. They sign the contract. Probably by the time number 5 is signed, number 1 has escaped. But anyway, part of the deal. Then they send their money. You have to do your anti-money laundering check. Issue the certificates, that kind of jazz. We kind of do all that for you, basically. It might, that So if it would take you 10 to 12 weeks to get an investor interested in what you do, to invest, to get them to, okay, I probably want to invest, let's get down to brass tacks, it'll probably take you 10 to 12 weeks again to actually get the money in the bank. And we have shortened that second 10 to 12 weeks to 3 minutes, basically, and eliminated a lot of steps. So we've digitized and standardized everything. All right, let me quickly move on. So what do investors look at? Maybe nice to know how many time they've left, 9 minutes. From the perspective of angels, what do they look at, right? So they need to like what you're doing. If I'm not into green tech, then talking to a green tech startup is going to be interesting, but it's not something I'm going to, spend 5 to 7 years of my life with. By the way, in Europe, that's kind of the amount of time before successful startups make an exit. 5 to 7 years is how long you're bound to them. So in a way, it's kind of like maybe a short marriage, but it's a marriage nonetheless, right? You're bound to each other for 5 to 7 years. So first thing is, do they like it? Second is, do they think that you as a team are going to make this a success? Third is, how far along is this? How real is this? Is this an MVP? Are there paying customers? Et cetera, et cetera. Who will buy this company? AKA, how am I gonna get my money back? There are kind of 3 ways people can get their money back. The company can be bought, right? In year 5 or 6, the company can go to the stock market in an IPO, in year 8 or 9 or 10, or they can be bought out, in year 4 or 5 during the A round. Those are the logical ones. And the 5th is, are there any weird things? Every startup has something weird, right? Don't be ashamed about it, but they're looking for this weird thing. Do you have like a debt of 300,000 euros? Is the IP still in this funky little Ukrainian company, but the Dutch BV is issuing the shares? Is there this weird investor that has preferred rights, that everybody should wear green hats when there is, when it's a Tuesday? I don't know, but there's always a weird. The last one's obviously not true, not a real one, right? But the other 2 I have seen in real life. But every startup has something weird that and so the investor's looking for something like. All right, so how do we talk to investors? Well, we talk to them, funnily enough, as if they are human beings, which they are. Like I said, investors are looking for good startups, and so you want to very quickly, and preferably in a short period of time, maybe in 30 seconds, if somebody asks you, so what are you doing? You want to introduce what the company does in 30 seconds. You don't have to tell everything, right? Because as you see in this little picture, if you move further down the funnel, right, starts with an intro, then Q&A, then request for 1-pager, 10-pager, and then, do you have your business plan? You will have plenty of opportunities to give more information, more in-depth information. But if you fumble the first interaction, then you're not going to get all those other interaction points. It's kind of, maybe let's do the, analogy of dating. If it's that first moment that you sit down and some say, well, what do you do? And then you start, listing your CV from A to Z, that's super boring. It's actually not, it's not the setting to do that. Usually you say, I have a cool little startup and we do this and this. Oh, that's super cool. And you just, so if an investor asks you, hey, what do you do? Don't, give the 3-minute prepared pitch. Don't give the canned speech, because I've been on that receiving end for more times than I can count. And I really just disengage. I say, that's very interesting. Thank you for your time. And I move on, because there are other startups that's, I can talk to. So try to, in that first interaction, again, don't sweat it, right? Just, be relaxed, be yourself, and explain in, maybe 10 sentences, 5 sentences, maybe even preferable, what it is that you do in such a way that everybody can understand it, and in such a way that if they understand it, that they can get interested. Because I can't get interested in something I don't understand. But if I understand it, I can make that thought like, hey, green tech. What actually is green tech? Hey, what's green tech? And then we get into interaction and Q&A. That's what you want, because that's where the human component comes in. And if the investor then understands what you're doing, likes you, has trust in the team, then you'll get to more points. So again, don't try to condense your 20-page business plan into the first interaction. It's a killer. And then I'm just checking to see if there are any questions. All right. And then I'll blitz through these ones, but these are some standard phrases angels might use, so that you don't have your rose-tinted goggles on or earphones on, and you think that this is a huge commitment when actually it's the angel being polite. So if they say I'm out for now, it's not a rejection. It is them saying sorry, I'm not going to invest right now. But like I said, keep him in the loop. It might be that the next funding round or the next week when there's better traction. So I'm out for now. It's a polite thing to say, and you also react politely. Say that's not a problem. Shall I keep you up to date? If they want to invest, they say in principle I'm interested. Can you share terms? So this is not a hard commitment. It's also not a binding commitment. It's just them saying let's take the next step in the stance. Can we send me your deck or whatever you have? They need more information. And if they say, or whatever you have, you could reply saying, sure, here's my deck. Is there anything specific you're looking for, right? I don't believe in startups making specific documents for investors, but there are a couple of standard things you might need, like a pitch deck, obviously. But if you find yourselves creating document after document after document for that specific investor, you might consider drawing the line somewhere, because if you're doing well, it's a numbers game. You're not dependent on one single investor. You always want to have your options open. Never let yourself be dependent on one single investor, because that'll lead to a squeeze, maybe or probably, right? Always try to have multiple investors that you're kind of playing against each other. Shall we have a coffee? For the non-Dutchies, that's a very normal business thing to say if they want to meet face to face. Are you available for a call? Well, they're gonna have to ask questions. If they say, normally I invest between 5 and 10,000 euros, or between 500 and 1,000 euros. You might also ask them, so what's the normal investment spread that you have, or what are the amounts that you normally invest? So this is to manage expectations. Or if they say, at the moment I'm not investing in lots, they say that's not a problem. I'm actually also looking for mentors. Would you be interested, etc., etc. So this is just to manage expectations. You could also ask about this. Expectations could be managed in the amount of money, the risk appetite, the amount of time they spend to mentor, the network they bring in. You could try to go for one investor that has all these components, or you might try to go for a little group that has, that all bring those components as a group to the table. It's up to you. There's no right or wrong way to fundraise when it comes to do you go for one person or a group. There certainly is, I think, the aspect of having selling off too many shares. One thing though, if you do decide to go for a group, you don't want to crowd your cap table. So I would always recommend, if you're going for 3 or more investors, set up a special pooling vehicle. SPV, special pooling vehicle. What it does is this. So your cap table are the people that are in my last minute. So this is how important I find this comment, right? Because it's almost my last comment. You don't want to crowd your cap table. Have you ever had this situation? You're with 5 friends and you're trying to decide where to go out for dinner, right? It doesn't work. Chinese, Italian, no, Vietnamese, it just doesn't work. Now imagine you, 3 founders, 3 investors, being at the table to decide at your shareholders meeting, are we going to do B2B, B2C, expansion to Germany or France? Okay. 6 is okay. Next funding round, we add 4 more people. Suddenly we're 10, right? That's a killer. You can't. A VC is going to look at that and say, "This is a Christmas tree." It's what it's actually called as lingo. Fix this. What you want to do is you want to have, in Dutch, it's a stock. With 3 or more investors, you want to pool them in a separate entity, in a pooling vehicle, so that one entity is a direct shareholder and all those other ones are a separate shareholder. Now you'll have to do some legal trickery probably then to simulate the voting rights. It's a bit technical, but you can read up on our website. This is one of the main components that Leapfunder does, actually. So we make it possible for a group of investors to invest in your startup without it messing up your cap table, and you stay investable. Cool. That's it.
Could we go with questions?
Yeah. So here's my email. I'll quickly look at the questions real quick. Crowdfunding, Mark. Yeah, thanks, Mark, for giving a lot of answers. Really nice. Vikesh, John Barlow, interest? No. People spamming. So you spoke that you charge staff a small fee, which is fair. What about investors? No, I already answered that. All right, I can't read because people are typing in chat. So quick question round.
I would like to ask a question because maybe I missed a little bit introduction, but I understand that on a platform it's possible to find an investor. So my question is, how many startups which is currently subscribed to the platform got invested?
We've done 150 plus rounds with about 80 startups, and about 70% of our startups reach the minimum amount, but they set the minimum themselves. So, but those are the metrics I have for you.
Do you do some kind of evaluation when the company is joining a platform, how visible the business is, so you can evaluate prior to joining, what are the chances?
Gotcha. So I'll never sell you hope. I'll never tell you, oh, this is going to work, this is not going to work, right? Because I can't. I'm not the man with the money. I wish I had the money of 1,500 angels, but I just don't. What I do is, you can, if you email me, we can have, it's in the chat. I do a quick 30-minute call with any startup, preferably EU-based, right? But I can also, because that's where our core of our operations is. And I discuss funding options with you. And maybe one of them is, hey, do a pre-sales. And then, you know, and sometimes I say, I wouldn't recommend doing a round right now. But yeah, so it's not a screening per se, but it is kind of like, hey, we've got, you know, data points of 150 plus rounds. And so I do share, I've never, you know, I do share kind of best practices and that kind of jazz. At the end of the day, it's an open marketplace. So stuff might go crazy, you know, it might do 0, it might just go through the roof. I don't know, but I can share, you know, what's happened in the past and what tends to work. And then startups that do say, hey, that sounds like a plan and sign up with this, we do give you as much coaching as we can and try to introduce you every 2 weeks to potential investors until you've, you know, we think that you've seen them all. And then, you know, we kind of quietly say, hey, oh yes, sorry, my email is totally wrong. Thanks for that. Thanks, Mark. That's what you get when you type real fast. So yeah, that's does that answer your question, Hannah? Right?
Sorry.
So yes, we do help, but I don't give any guarantees up front because I just, you know, I don't know. That's the beauty of the people, the angels. They make up their own mind, but it's also sometimes a bit of a handicap. If you have a work BV in which they invest in storage, yes, Vikesh, they have a problem with that. So let me tell you this way, right? I have here is the entity, right? Here's the entity that holds the IP, which is all the value. And then here is the IP, where is the money in? And then between is a little agreement. But this company, so here's where the investors get in, right? So here's where the risk is for them. And here's the agreement saying, no, you can use the IP. But what if this company, which has the IP, just says, goodbye? Then you're in a worthless company because there's no IP. So yes, an investor will always want to get into the top holding, where the IP is, where the value is. What you could do is you have the top holding with the IP, and then you have here is the work BV, where the P&L, where just the, you know, where just the admin and the transactions and stuff take place. But they want to get in the top holding. Any other questions? I'm looking also at the moderator, right? I mean,
exactly,
cut me off.
Yeah, Dennis. Considering all the questions that have been asked, there seems to be a lot of interest and engagement from all the attendees, which is super good. But for now, considering the time and our next session and speaker, I would like to go over to the next session.
Yeah, apologies, by the way, to the next speaker.
No worries. You did a great job, I think. Still a lot of questions that are being asked. I would encourage everyone to ask your questions using Dennis's mail or simply stay in the in this session, because the following session will also be very interesting for you probably. So for now, thanks a lot, Dennis, and I would like to give the floor to Anushka.